Alright, this is James, the Giant Economy. And last night I was talking to some friends, and we were talking about the economy, what's happening, and they were talking about the stuff in the stock market and some other stuff. And they're going to be in a big move. They're kind of going from one side, they're going from the bottom of the U.S. to the side, I guess. So they're going across the U.S. And so we talked about housing and all this other stuff. And it got me thinking, I should do a video on the state of the economy. And since life is always busy, it seems, I'm doing it right here in the gym on the treadmill with you. So if you are like me, you're probably listening to this as you're doing cardio, which is completely fine, and I think a great use of time. So let's jump into it. Let's rewind a little bit back to, we'll say 2019. Okay, we're going to go into what happened in 2020. We'll fast forward to where we're at today and what's going to happen in the future and how you should prepare for it, right? At least in my mind. Now, this is financial advice. I'm just a guy that doesn't have blue hair right now, but has on occasion and just loves to take a month or two off and travel and just wants to work if he has to or not. You know, as a guy, I want that freedom. You know, you might say, hey, I want to make billions. I don't care if I work, 120 hours a week. Cool. You are right up there with Elon Zuckerberg and Bezos, but I'm just a bit different breed, and that's fine. You choose your lot in life and you live it. So 2019, what was happening, right? If you had your ear to the ground, you noticed that leverage was starting to build up. In other words, people were taking out a lot of loans, right? And loans are great. They help the economy rev up and spur up even faster. You look at countries, especially like South America, that don't have a lot of credit, and they are slow to grow, okay? But they don't crash either. We'll get to that. At least not as much, let's put it that way. But leverage is starting to build up in the system, okay? And by leverage, we mean loans. And you can do this to a certain point, and then then you have to have a risk factor, right? This is why when you're buying a house, mortgage lenders want a DTI, debt to income ratio. So if you're making $100,000 a year, and per month, let's just say $10,000 a month, and your debts, you're paying $4,000 a month going out, your debt to income ratio is like 60%, and they want over 50% typically, because when you buy that house and you count that house, and it might be $3,000, so all of a sudden you're at $7,000, right? And you've got some other stuff that might come in, but they want to make sure, and that's still under your 10. They want to make sure that you're not over leveraged, right? Because what happens when you over leverage, when you have too much debt being pulled out at you and you can't service it, your debtors foreclose, okay? They come to you and they say, hey, you haven't been paying your debts, you haven't given us the money that we agreed to, we're going to take back whatever our collateral is, okay? And lenders know that if you default in one spot, typically it's like a bunch of dominos that go down the line. But anyhow, in 2020, companies were starting to get to this very large leveraging point to where it's like, hey, they're kind of hitting the red, they're kind of going a little too far. If something changes in the economy, like if their sales go down 10% that next year, they won't be able to service their debt. And then they're going to go under, right? That was in 2019, and a lot of people who were keeping their ear to the ground in the financial system saw this. I even saw this in real estate, because instead of like when I was door knocking or when I was putting on bids for homes, I was back in 2000 or 2016, 2017 or whatever, I was like one of 5, right? If that. And now in 2019, I'm like number 15 out of 35. And I'm thinking, I'm not going to get this home at the price I want it to, right? Because he's going to have so many people that are overbidding, that are willing to take more risk, right? And to make the deal. And that's great for the homeowner, because they're the ones selling into that. But as a buyer, it was not, the juice wasn't worth the squeeze, right? I kind of saw that writing on the wall. So I had a choice to make. I could either get more risky or not do it, okay? And if that was your only business, you only got one choice, right? You don't have the luxury of not. You don't have the luxury of not pulling back, right? Anyhow, so 2020 hits, and the big how do I say it on the tubes? The 2020 cough. There we go. That hits. Everything shuts down. And as a nation, as a world, we find out a few things about American businesses, right? Basically, we found out if your business puts objects in the air or at sea, then you can't go without a paycheck for a month or two, right? So if you were, like Carnival cruise ships, or you had a cruise ship thing, they were considering bankruptcy 2-3 months in, and you're like, what in the world? That is horrible business principles. Okay, they say that for business, if you run a business, you should have 6 months of business income in the bank at all times. And if you're running a small business like myself, you should have 6 months of business income plus a year of personal income in the bank. Or, like me when I first started out, you work an extra job or two to make sure your bills are paid, right? You don't risk that stuff. Big Miss is a little different, but the principles are the same. You still need to have some sort of form of a collateral or something of some sort of cash in the bank so that you can survive without a paycheck or two, okay? Same thing with the airlines. They started to go like, hey, we're either going to lay off all of our staff and try and rehire them or something, or I don't know what they were going to do, but they were going bankrupt at my point. And so the government threw a ton of money at them. They threw a ton of money at all these businesses. They say $5 trillion, but I've heard $1 trillion is unaccounted for. They don't know where it went. And so I'm thinking in the back of some people's pockets that they don't want to tell us, but $4 to $5 trillion into the marketplace, right? They did that through PPP loans, through stimulus checks, through SBA loans, all this stuff, right? Next thing they did was they stopped foreclosures, okay? They said, hey, no more foreclosures, no evictions, or all that stuff. And they said, hey, we're going to quantitative ease. We're going to let the market. We're going to help the market out by buying stuff. Put it on our balance sheet so we hold the risk to help the market de-risk, right? That's what they did in 2020. Fast forward, and then everything went up. Housing went up. There's no inventory. Also they shame on me. They put interest rates lower, right? So interest rates went low to zero. So to us from the banks, it was only like a 2 to 3% loan that you can get. Fast forward to today, they're raising rates. They're starting to do quantitative tightening right now, and there's no more free money. And so what's going to happen? So they did all these things that went up. What's going to happen now? It's going to go down. The Fed even wants this. They've said that, hey, we want housing prices to go down. We want stock prices to go down. And this is how we're going to do it. This is very different from the last bubble because we got a bailout before asset prices fell, right? So in the 2008 crash, the thing crashed, credit, people were over-leveraged, credit hit, and we got some bailouts afterwards, right? They bailed the banks that were failing. And this time, they bailed them out first, and all the asset prices, the stock markets, the markets, the housing market, everything went up, right? Even the cars got more expensive. Like, the used car was worth more today than it was 2019. And I'm like, it's a depreciating asset, man. It makes sense. Anyway, but this is the crazy stuff that's going on, and it's going to swap back and go pretty hard as the Fed starts to raise rates. I heard interest rates for a house, if you have bad credit, right now they're at 7%. I'm like, dang, if you have good credit, they're like between 5 and 6. And I'm like, oh my gosh, that's rough. With asset prices as high as what that is out there, that's a bad thing, man. Stock market is at a hole. It's down 10 to 30%. It's having this little bounce right now because people have hope. But everybody in the know says it's going to be a dead cat bounce. It is to try and suck more liquidity out of you guys, and then make people just sell off into it, and then they might short the market or something like that and make more. Fed says it's going to do quantitative tightening, right? So in other words, instead of taking assets off the market, they're starting to sell assets back into the market, right? More supply equal demand equals lower prices. So that's what they're going to do, and they're starting that this month, and they said they're going to tighten for like 2 years, man. They may change their mind, that happens, but 2 years. So here's how I see the cards falling, the dominoes falling, right? Number one, the stock market's already started to take a hit. Interest rates, as interest rates goes up, the value of the dollar, which I'm getting to in the video, goes up, and especially overseas. So, real quickly, a lot of debts overseas are denominated in U.S. dollars. What does that mean? Who cares? Well, they care, because if they're in China or if they're in Spain, they can't pay with pesos or Chinese yuan, right? They have to pay those debts back with dollars. Just think about if you loan somebody money. You say, hey, I'm gonna loan you 10 grand for something. They're like, hey, I'll give you 8%. You're like, hey, that's kind of cool. And they say, hey, here's, 3,000 pesos for my payment this month. And you're like, what? No, change those out and give me dollars, right? I mean, that's what your contract says. You pay me back in dollars. So what happens as the dollar gets stronger, as interest rates raise up, they have to pay more, and they need more dollars. Well, when everybody needs more dollars, the value of the dollar goes up, okay? And when they're in those other countries, they can't just print money to pay it, because the more money they print, the lower the value goes to the dollar. So the dollar's here, if they're equal, and they're saying, we need to print some more money, well, if they print like 3 times as much, it's gonna drop. So it's kind of like a nillo. It doesn't do anything but devalue their currency, right? So that's what's happening. Like, the dollar's going up in value. That means people are very much needing the dollar. Interest rates are rising, which kind of causes that too. It says, hey, the dollar's more valuable because everything costs more now. Interest rates rising affect tech. They affect credit cards. They affect house prices. They affect business loans. All the basics, but all the assets, in a sense, not all of them, not 100% of them, but a lot of the assets that you get a loan on, they affect. There are some things that they don't affect, like commodities. Okay, they're not going to affect the price of wheat, or the price of oil and gas, or the price of gold. Not directly, anyway. Quantitative tightening, that's going to affect everybody, because they're going to start putting things like mortgages back on the market. They're going to start putting like assets they have purchased back on the market, and it's going to lower their value, because all of a sudden there's a new seller in town, and not just a small one, a big one. And they've already started to do foreclosures and other things like that, to where they are starting to come back on the market, and that's going to be a slow trickle. So here's what I foresee happening, right? Stock market's already started to take a hit. We know inflation is raging, and unemployment is at an all-time low. And people are like, we're in a recession, but not really. I'm like, no, we are. Just give it some time to play out. And this is why. This is how the dominoes in my mind are going to fall. The stock market is going to start to go down. It already has. It's going to go even farther down. Not financial advice, but I'm pulling all my stocks. I've already pulled them all, and started to short things. Right? Not saying do that. I'm saying I would not want to have money in the stock market right now. I would rather pull it out and go to cash, right? Because that's going to be more valuable in the future. If the stock is going to go down, then cash out now, even if you lost some money, right? Because at the bottom of that even if you lost 80%. When one of my friends said they lost 80% on a certain, I forget, it was a gold miner or something like that they bought into. Cool. Pull that 20% out. It'll be worth 50% at the bottom of the market, because here's the thing: $1 million in a recession is worth $10 million, because it buys so much more, right? Think like that. Like, the more cash you have, the better everything's, because you can buy more, especially when people are hurting. And if you know someone that's hurting or whatever, share this video with them, man. We need to get this out so the people that want to listen, to the people that want to learn, the people that don't want to get hurt. Because we don't want anybody to get hurt. But those people that want to stick their head in the ground and the rear end of them there, well, they're going to get paddled by the economy. And hopefully that pain will teach them to learn, right? That's the hope. So stocks are going to start to go down. They're already going down. They're going to go down even further. When this happens, when this happens, it's going to be because of company profits, right? Inflation is eating that away. Consumers are saying, hey, I only have so much disposable income to use, right? I've got to start to be picky and choosy. And so corporate profits are going to go down lower, And when a corporation or any business is saying, hey, we've got the max amount of marketing that we can do, we can't do any more marketing and trying to reach more people, and our profits are going down, there's only one other thing they can adjust, and that's outgoing expenses, right? So what are they going to do? One of the most expensive things in a business is the cost of people. They're going to start to lay people off. Or they're going to look at their location-based and say, hey, these three aren't performing as well as the others. They're only performing at like a 20%. The others are giving us a 50% yield. We're going to shut those three down. And that would cause, loss of jobs as well as, shutting things down. And this thing trickles throughout the whole thing because the landlords don't get money for that business anymore. That was in their spot. And so we would see this happening in tech. Right? Again, tech's been in the forefront of the crash. Like everybody down a bit. Look at Facebook, look at Meta, look at Google, Apple. Tesla's this weird one where it's kind of shot back up, but it'll come back down too. And then here's the principle: when the tide rises, all the ships go up. When the tide goes out and falls, same thing. In fact, Warren Buffett said it best: when the tide's in, everybody looks like a hero. In the up market, everybody looks genius. But when the tide goes out, we see who's naked and who's still got their swim trunks on. So all these other YouTube, like, I'm a gagillionaire because I've invested in Bitcoin, and now it's like down, God, it's down like 60% this year, 70%. And a lot of people are saying there's a good 70-80% chance it's going to go lower. So I'll probably buy Bitcoin around 7K, maybe 9K when it breaks 10. We'll see what happens at 19 or 817. See what happens, if it holds or if it goes. But so companies are already starting to lay people off in the tech sector. All these people are going to start looking for jobs, and they're tech based, so they're going to start looking for tech jobs, right? And if everyone's looking for jobs at the same time, it's a ton of competition. Tech companies are laying off, so they're probably not going to be hiring people back. In fact, they're kind of doing some hiring freezes right now, or retracting their hiring offers. What else? So what else is going on? So the next domino. Sorry, I ran on my 30 minutes of time. Faster than that. I got to get this stuff off. Anyway, so the next domino will fall. Right? There's the stock market, and then what's going to happen is layoffs are going to start to occur. Right now, unemployment's really low because people have to work. Inflation's really high, so they're like, hey, I need to work. I need to get to make some money. Also, the way they're counting it is very different. So if you work for Uber, and if you work for Lyft, they're counting you as having two jobs. Hey, you're double employed. They're counting as two people in a sense. Or if you work as a nanny or like a nurse, and then you work as a bartender at night or something like that, they'll count that as two jobs. Oh, double employee, you got two jobs like that. So the numbers are a little skewed, and we kind of know that, but we still know that, hey, there's a lot of people out there working and trying to find money and make money, right? Well, as unemployment goes, they're going to start to look for other jobs, and they're not going to be able to find them, right? And when you don't have a job, there's two ways you can survive. One is off your passive income investments, right? Not a lot of people have those. Number two is off your savings, right? Eventually, that may run out. How many people do you know have 6 months of savings left in their bank, right? That they would tell you, something like this person. But the average American doesn't have $1,000 in the bank account. Okay. So what happens next? Once the savings is run through, you start to sell your assets, right? Your cars, your gold, your Bitcoin, your houses that are making money, or making enough money, right? Maybe only making $500-600 a month on a house. Like, well, I got $30,000-$40,000 in equity. I'll just cash in it right now. I'll sell it, get the equity out, and have more type thing. And so that's a viable solution. But people are going to start hurting. They're going to start selling stuff. And when that happens in a mass amount, prices will go down. Asset prices will then start to fall. Okay. And that's when you want to start to buy, because those asset prices fall of everything from houses to cars to companies. And then people who are wise with their money, the people that see it, people that have heard this video, are going to go through and they're going to start to buy those assets at pennies on the dollar. Both companies, both physical assets, everything from gold, silver, Bitcoin, oil and gas stuff, everything is going to be on sale, okay? buy them. And there's going to be a point to where we've bought enough stuff that we're going to start to restructure things and make them more profitable, right? And then we're going to start to hire other people because we're going to start to expand. And that's when the economy starts to build itself back up. We saw this in 2008 is a great example, right? 2007 started the tip, kind of where we're at right now. It was, I'd say early 2007, started the tip, started going to 2008 and 9 when a real bad crash happened. And the bottom of the bowl was about 2009, 2010. And then we started to go up at 11 and 12 again. We've been going straight up, like straight up since then. And we haven't had a pullback yet. We haven't had a recession. We are really due for one. And I think this one is going to be really bad. All the smart billionaires that I'm listening to, people that I know are saying, they're thinking this recession isn't going to be like the 18-month, 2-year one. They think it might be long and drawn out. They're thinking it's going to be bad, like maybe a 5-year one. I don't know what to think about it, but I'm thinking that it's very smart to listen to these guys and to say, okay, let's plan for that. You know, because if we're wrong, okay, we can just buy a 2011 type thing where it starts to go back up, right? If we're right. But if we're wrong and we start to buy, in this case in the 2008, 2009, we buy too early and it just keeps going down, we could be in for a world of hurt, right? We could be bad. But anyhow, that's how, in my mind, the economy is going to go down. And that's the order of it. So stocks are going to start to, company profits are going to start to fall. That's going to affect stock prices. Then they're going to start to lay people off. Those people will be jobless. They'll be looking for the jobs that won't be available because everybody's lying out, because everybody needs money, right? And then what's going to happen is they're going to start to sell their assets. They're going to start to sell the things that they hold dear to them, sad enough as it is. And they're going to sell them for a cheap price because everybody's needing money, right? And then it'll start, after a moment of time where it gets so deep, it'll start to level itself out and go back up. So what do we do about this? Like, how do we prepare? For one, if you're in something that you know is going to go down, sell it. Just sell it, take the money, pay your taxes on it, it's fine. Or find a way to talk to your accountant in a way to mitigate legitimately mitigate your tax liability. But do it. If you have a bunch of rental houses, sell if you go into cash for a little bit. I did that with mine last year. Sold them at the late last year, early this year. Sold them at the height of the market, because things have already gone down. So go into cash. Some people are saying bonds are probably going to be a good play. TLT in particular, because that's where the big money runs to safety. So what I mean by big money, I don't mean like, oh, I'm a millionaire. No, that's in the world of bonds and economics, that's small fries. We're talking about people that manage billions of dollars, and they have to make a profit on these billions of dollars for their clientele, right? So let's say all the teachers in your state are your clients, right? And you've got their retirement fund. They're like, hey, we need to make this much money per year on average, and they're responsible. Okay, cool. Here's $4 billion. Make money with it. Well, you're not going to buy one house at a time, right? You put it on the stock market. That's a little riskier than all stock. So what do you do with it when things really go into trouble? A lot of them say, hey, what is the most pristine collateral that has never defaulted ever? And that's the U.S. Treasury. So far, it has never defaulted on Solana. And so they will put them into Treasury bills, right? Not only that, but as the Fed raises rates, the yield you get back goes up a little bit, right? So a lot of them are saying, hey, we can buy some real estate. Big companies buying real estate. Have you heard that yet? And create a renter nation. And that yields us on average with repairs and management fees and all that stuff. It'll yield us like 3%, maybe 4%. But that's kind of an estimated kind of way. Or we go to Treasury bonds and get a guaranteed 3 to 4%. Guaranteed, like there is no if, maybe. what are we going to do when times get really hard and we don't know where people are going? We don't know what's going to happen. We're going to shift. We're going to sell our houses and we're going to put them into bonds. So if you're already in bonds and you ride that wave up and you sell the top type thing, that works. Another thing and you see a lot of big players like Warren Buffett just got 50% or approval to buy 50% of Marathon Oil. Big short guy. Name pops out of my mind. Michael Berry. Thank you. Michael Berry. He bought a lot into a gas company that grabs natural gas out of it. He's very bullish on oil as well, oil and gas. And so that's what I'm doing. I'm buying oil and gas mineral rights. And I'm making a ton of money on it, man. For my cash on cash. So this is what I did. I sold my houses. The profits I got from them, I put into mineral rights, right? Different tracks. So I have no debt. No debt whatsoever anymore. I'm debt free. And I'm getting like anywhere from a 30 to 45% return cash on cash on the money I put in. I mean, so if you do the math on that, let's just say you put $100,000 into these mineral rights, right? That means you're gonna make $30,000 to $45,000 this year. Completely passive, inflation protected, recession resistant, completely passive mineral rights that you don't do a thing for. You just let these giant oil and gas companies, these billion-dollar tenants come and do the work, and you're like, cool, I'm just gonna chill, man. It's the rental homes of the oil and gas world, right? And man, it's amazing. That's what I'm doing. And then the last part, just go into cash and wait. You know, as investors, there are times to invest, there are times to divest, and there's just times to wait, right? And that waiting gets a lot of newbie investors, okay? Especially ones that haven't seen a crash. By the way, anybody under 35, don't listen to them financially. Don't do it. Go to that gray-haired guy and say, hey, that's been successful, not the ones that don't know anything, but the one that you can tell has been successful, they've been through an economic crash before, and ask them and say, hey man, what should I do? What's your thoughts on it? This crazy guy who says his hair is blue, but it's not right now, and just wants to retire at a young age, he's telling me this. What do you think about it? Go ask them that, because anybody under 35 doesn't know what it means. They've never seen an economic crash, right? They graduated college outside of one. Now all they've seen is a run up. All they've seen is stocks go up. All they've seen is housing goes up. All they've seen is my pet rock goes up in value, okay? That's all they've seen. And so they don't know what it's like to be at the top of the mountain and trip and fall all the way down and just slide all the way down and roll. They don't know what it's like to go through the valley and then come back up. The older guys do. The wiser guys do. And that's what I'm listening to. And that's where I'm getting my thoughts from and what I'm telling on this channel. So hopefully I'm way overdue. I'm going on 30 minutes. So this is supposed to be like 10 minutes, but I just yammer sometimes. Anyway, if you're interested in oil and gas mineral rights and you want to know more about it, give me a call, email, text type thing. We'll talk, we'll connect, and I'll get you hooked up. Either way, I hope that the future goes well with you, and I hope that you're prepared. Not necessarily scared, but that you're prepared for what may come, because it's going to affect us all. It's going to affect the world, is what people are telling me, and I don't want you to get hurt by it. It's better to sell a year too early than 2 days too late.